gains too, an additional 3.8. That's kind of a tiered rate too. So the income levels at 200,000 if you're single or 250,000 if you're married, income levels are greater than that, then that tax apply to your capital gains. So 700,000 estimated total tax, 130 to 193,000. It varies depending on the state. You'd have to imagine being in the state of California, you're going to be on the high end of that. Plus the depreciation. I mentioned before, if you take depreciation on the property, if you sell it and don't exchange, the IRS wants 25% of the depreciation back on the depreciation. So $100,000 depreciation total taken, the IRS is going to take $25,000 of that. So as you can see, the whole idea of the exchange for you and your clients is, instead of paying maybe $200,000 in tax to Uncle Sam and selling a piece of real estate, if you buy other piece of real estate you're also going to hold for investment, you retain that $200,000 and apply it towards other property that's going to hopefully net you more income or whatever purpose the client wants to exchange. So let's go on to the next slide. IRS 1031 requirements. Let's jump to the next one. So what is the requirement of a 1031 exchange? So 1031 is a tax code. So what we have to do is we have to take you through the whole process, the tax code to a T, so you can have a good exchange and defer those capital gains tax. It must be an exchange. So qualified intermediary, that's me, that's First American. We act as a qualified intermediary for you and your clients in a 1031 exchange transactions. One of our main jobs is to assign ourselves into the transaction as seller on the property that's being sold and as buyer on the property that's being purchased. So we have to take the client through the process. We create a two-party transaction. So don't be confused. A lot of people think if you're closing concurrently, you do not need a qualified intermediary. That is not true. A qualified intermediary will still need to be assigned into the transaction for you to have a good 1031 exchange. Like-kind property, we talked about this a little bit before. You know, you got to sell real estate held for investment and buy other real estate that's held for investment or as business. So you can run the business out of the property. You have to follow time deadlines. So 45 days to identify, 180 days to close. So most of your exchanges, let's say you close today on the property you're selling, you only have 45 days to identify what you're going to purchase. You don't have to be an escrow and contract to identify, but I recommend you do because you cannot change your identification after day 45. And then you have 180 days also from the close of escrow, not from the 45th day. 180 days from the close of escrow of the property you sell to close on what you identified. Now that a lot of you might be here today because of what's going on in the world with the COVID-19, the IRS did grant an extension on current exchanges that we're in right now. Last Thursday night, they issued something that basically says if your deadlines go into April 1st and July 15th, you do get an extension. Actually, it's on more slides, so I'm gonna carry on the other requirements here. Equal or greater value. This is important. A lot of people think they don't have to buy of equal or greater value. So let's say you sell for $1 million and you cash out $600,000 in equity. You paid off a $400,000 loan. You want to take that $600,000 equity and buy something for $1 million. If you buy of lesser value, you still may benefit from the exchange. You just pay a tax on the difference. I like to say if you got a 16-ounce cup of coffee and then you need to pour it in a 12-ounce mug, you're going to have 4 ounces left over. So that's going to be taxable because you couldn't pour it all into the acquisition or replacement property. And then same taxpayer rule. So, you know, if I'm Ken Harris selling under Social Security number 123, I need to show as Ken Harris buying under Social Security number 123. So we'll expand on each of these on the next slide. So let's jump to the next one, Jerry. Terms of the exchange, I might have said some of these already. Relinquished property, replacement property. So relinquished property is the property that's being sold. Replacement property is the property that's being purchased in the transaction. Qualified intermediary, that is us under First American. We act as a qualified intermediary. And then boot, we'll get into boot. Boot is basically taxable. Most of the times it's viewed as cash. So it's an exclusion from the exchange. So let's say your client wanted to remove $50,000. They could do that, not roll it into the exchange and pay a tax on that. So we'll expand on that a little bit further too. So let's jump to the next slide. Sign exchange docs. Okay, so anytime you want to do an exchange, I think most of the people here are agents. You really want to be proactive. If you guys get that listing and you know it's an income producing property in any way, shape, or form, that's when you want to bring up the 1031 exchange to your client. See if they're familiar with it. See if they need it. See if they want it. Maybe they just want to pay their taxes. But the great thing for you guys is typically if they're going to do the exchange, they're selling and then they're buying. So you have clients, you know, doing multiple closings within a short period of time. So, you know, I got one client, he's selling one and buying 5. So, and the same real estate agent handles those at a time. So it is a client that you want to be, you know, be in touch with. Constantly, you know, call them and hopefully get a lot of closings out of them. Qualified intermediary holds funds. So us being under First American, we have to hold the funds. The client's not allowed to touch the funds in the 1031 exchange. So what happens is upon the close of escrow, the proceeds, the net proceeds of the equity, I've called it to, comes into us. And we park those and then place them to acquisition of the replacement property during the time frame of the exchange. So coming with First American, if your clients are talking about 1031 exchange, who do you pick as a qualified intermediary? I always say the most important thing in picking a qualified intermediary is the financial security of your money, because the money is coming into basically a third party, us. So by the backing of First American Title with Jerry and Eric, they're, you know, multi-billion-dollar company, which we're under the same umbrella, the same family, will guarantee those funds with our company. I think that's one of the most important things that sets us apart of a lot of qualified intermediaries is the financial security of First American. And then we also open up separate accounts for every client. So the funds that we hold also gets the FDIC insurance. And that's kind of another level of insurance too. So let's say you were to wake up tomorrow morning and the First American doors were shut. We were poorly managed and we, you know, businesses shut down. There's an account there with their name on it to obtain their funds back. I don't want to alarm you there. First American's been around since 1889. We survived the Great Depression. We survived the Great Recession. I think we're going to get through this COVID-19 situation just fine. So we plan on sticking around for a long time. Let's jump to the next slide, Jerry. What is like kind? So like kind properties, any piece of real estate held for investment being exchanged for any type of real estate that's being held for investment. So if you see in this slide, there's different types of property. You got commercial, you got apartment complexes, you got retail, single family residence, and then there's vacant land. So vacant land is the one type of property that you can actually do a 1031 exchange on it that isn't necessarily income producing. So a lot of times you have vacant land just sitting there, you're paying a property tax on it, you're not making money on it. So maybe that's a good selling point for some of you guys, for your clients that hold vacant land. Maybe they can sell it, exchange it, and buy another piece of property that can net them a monthly income. So that's something to think about. One thing I do want you to know though is if you sell an improved property and then go to vacant land, you got to be careful because you could defer your capital gains tax, but you're going from a depreciable property that you've been depreciating and you're going to a non-depreciable property in vacant land. So you could defer your capital gains tax, but you'll still get hit with the depreciation recapture tax, which is that 25% that I mentioned on an earlier slide. 25% of that $100,000 in my example, it would still be due. So you defer the capital gains tax, but not the depreciation recapture tax. And another thing too is, are you buying of equal or greater value by buying vacant land? Sometimes, you know, obviously the vacant land might be of lesser value, so you got to be careful of that. So any piece of real estate held for investment is interchangeable. So you can sell single family residence, buy units, sell units, buy industrial, sell industrial, buy retail or commercial. So it's all interchangeable. So don't think that if you're selling a single family residence rental, you have to buy another single family residence. Okay, next slide. What is not like kind? Okay, so you have to buy a piece of real estate under that same taxpayer requirement. So it must be an investment property or property used for business. Primary residences do not qualify for 1031 exchange, but here's what I want you guys to think of. And this is really the most important thing you guys want to take away from today is the primary residence, if they're making money off of that somehow, some way, it still may need to be a 1031 exchange. What if they rent some of the rooms out? What if it's a duplex and they own both units and they're selling it and they rent it out one of the units? They're making money off of one of the units. What if it's a farm and they live on the land, but they do agriculture on the land? They may need to do an exchange on the land. So don't eliminate them from exchange just because it's a primary residence. Remember, if there's any type of income producing situation on that piece of real estate, they may need to do a 1031 exchange And that's when you'd want them to give me a call, and definitely have them always call their CPA for the advice there too. Vacation homes, personal use. So second homes and vacation homes for personal use do not qualify for 1031 exchange. It must be a piece of real estate you're going to hold for investment. Your short-term rental stuff will work, like an Airbnb type of rental. You could actually buy a mammoth condo, rent it out on an Airbnb, and then use it for personal use up to 14 days out of the year, or up to 20 or 10% of the time that you rent it out, and still qualify it for 1031 exchange. So there is a chance to get some, a small portion of personal use on a piece of property that you exchange into. So a vacation home may work if you're going to rent it out and use it for a short period of time each year on personal use. Held for sale, property purchased with the intent to sell does not qualify for exchange. So your flippers that buy property, fix it up, 6 months down the road, sell it, that does not qualify for 1031 exchange. You want the property held typically 2 tax filings, 2 years, I like to say, to play it safe. 2 tax filings showing a rental income or showing you're running your business out of the property, and then it should qualify for 1031 exchange. And then the last thing is, a lot of people want to take their money and roll it into stocks, bonds, or partnership interests. You must buy a piece of real estate. You cannot take your money out of real estate, buy stocks or bonds, and benefit from 1031 exchange. Another thing too is the partnership interest. You cannot go into like a REIT, a real estate investment trust, because then you're really buying an interest in a partnership. So, okay, maybe you have a 5% interest in this partnership that has assets, which is real estate, but you're taking ownership in the partnership, not the actual piece of real estate. So you got to be careful with that. In a situation like that, they'd have to take a tenant common interest in the actual real estate. So let's jump to the next slide, Jerry. Time frames. Okay, so this is kind of important. So let's get into this. Jump to the next one. So 45-day identification period. So here's your rules to identify. From the date of close of escrow, let's say you close escrow today, you have 45 days from today to identify. You have to submit something in writing to us, unambiguously describing the property. So it's a piece of property, 123 Main Street. If it has a unit number, you have to specify the unit number, the city, and the state, and submit that signed and dated by day 45. The 3 property rules. So there's 3 rules to identify on. 3 property rule, 200% rule, and 95% rule. 3 property rule says you can identify up to 3 properties at any value. Of course, what you buy, you want to meet your equal or greater value. So let's say you're only buying 1, or your client's only buying 1. They could identify 3, so they have 2 backups. So they identify 3, they close on 1, they're done. Let's say they sell for 1.5 million and they want to identify 3 $500,000 properties. They can do that and buy all 3 and be done with it. So, it's possible to identify 3, buy 1 of the 3, 2 of the 3, or all 3 under the 3 property rule. The 200% rule says property, if you want to identify under 4 or more properties, so the 200% rule could apply. So what it says is you can identify 4 or more. You have to apply a fair market value to every property you identify, and the total combined fair market value cannot exceed 2 times the value of the property you sold. So let's use that $1.5 million sales price. You could actually identify 4 or more properties up to $3 million worth of valued property. So you could say identify 10 $300,000 properties, and then you only need to close on 5 of them to meet your $1.5 million equal or greater value. So it is possible to identify 4 or more. It's not so common to see that, but typically you see that when your client wants to diversify and buy multiple properties, because then they're identifying lesser valued properties. 95% rule, I'll touch on it real quick, but I've seen it done twice in the 20 plus years that I've been doing exchanges. What happens is you don't fall in the 3 property rule, you don't fall in the 200% rule. So I like to use the example, you're selling for $1 million and you identify 10 $1 million properties. So you identified more than 3, that eliminates the 3 property rule, and you identified more than 2 million, so that eliminates the 200% rule. So what it says is you must acquire 95% of the aggregate value of what you identified. So if you fail to close on 1 of the identified properties, then you have a completely failed exchange, even though you closed on 9 of the 10. So that's why you only see it really on a portfolio closing where there's 20 properties, 20 gas stations, all over the state of California, and it's one purchase agreement, one seller, one buyer. It's all or nothing anyway. So usually you won't see the 95% rule. You want to focus on the 3 property rule or 200% rule. And then you have 180 days to close it. So let's jump off to the next slide, Jerry. I think it has a timeline there. So yeah, here's the timeline on so you close today. Tomorrow's day 1 of the transaction. You'd have 45 days from today to identify, 180 days from today to close. The 180 days is tricky if you fall on a weekend or a holiday. You cannot extend it to the following business day. It has to be the previous business day. So let's say you close on, or your 180th day is Sunday, you can't close the following Monday. You'd have to close the Friday before. So it could limit your 180 days to 178 days or whatnot. So you got to be careful with that on the 180-day timeline. The 45-day deadline, you can identify on Saturday or Sunday, no problem, as long as you take that identification form we provide you and submit it to us by day 45, whether it be by an email or a fax, that should be fine. Or even if it's postmarked on that day, it would work. So there's no extensions on these deadlines, except for now, under a situation like today. Let's jump to the next slide. Okay. So only right now, you guys, so you never can go into an exchange expecting an extension. It's rare. I mean, what they say is it has to take an act of God to get an extension on something like this. So we've seen them with the California wildfires, a major hurricane, Hurricane Katrina type of thing. They would have issued extensions in the past for those areas that were affected. So this is kind of different because it's affecting the entire nation. So every exchange right now, if your deadline falls within April 1st and July 15th, that deadline date is extended to July 15th. So if your 45th day is actually today, on what's today, April 17th, you actually now have until July 15th to identify. So if you're currently in an exchange, you may get more time to identify. You cannot extend both the 45-day and the 180-day right now, though. So let's say they identified on February 1st, the 180th day fell on June 1st. I don't even know if those numbers work, but in that case, the identification has to remain the same because they would have already identified on February 1st. So the closing of that June 1st date of 180 days is now extended to July 15th. So they have actually more days to close on what they identified by February 1st. So they wouldn't be able to change what they identified by February 1st though. So they can only extend right now one of the 2 deadlines. So if you have any questions on that, give me a call, let me know, I'd like to help you out. Next slide, Jerry. And you guys, I see questions coming in. I'm just gonna wait pretty much until the end and try to answer most of these questions in the end. So thank you for the patience. I think you went one too far, Jerry. But you know what, I think I talked, yeah. So this is the same scenario. So if your 180th day was June 13th, like I was saying, your 180th day is now extended to July 15th under the current COVID-19. So really for you to start benefiting with this current extension, you're gonna have to close pretty much prior to June 1st. So if you close prior to June 1st, you actually have a few extra days than the 45 days to identify currently right now. So we can jump off to the next slide, Jerry. Financial requirements, next slide. Okay, so equal or greater value. I did touch on this a little bit. Again, if I'm selling for $1 million, I have to buy for $1 million. Remember what you're doing is you're pushing your gain of the property to the next property. So we keep saying tax deferral. It's a tax deferred exchange, not a tax-free exchange. So it doesn't go away. It just gets pushed to the next property. For you to push your basis to the next property and then next property, you need all that value of equal or greater value to pour it all to the next property. So you can buy equal or greater value, you can pour it all in there and you defer it. So what a lot of my clients are doing in 1031 exchanges, they're deferring forever. They don't ever plan on paying a tax. So I like to always say they're kicking the can down the road till they kick the bucket. And then what happens after they pass away is they get a step up in basis. So let's go back to the previous, well, you don't have to go back, Jerry, but on the previous slide where you don't have to go way back. It's okay, stay there. On the example I used where there was a $700,000 gain. So let's say I owned a piece of property today for $700,000 gain, where if I were to sell let's call it a $200,000 tax consequence I have. But if I pass away today and my kids inherit the property, that basis of $300,000 jumps up to $1 million. So they could sell the property at zero capital gains consequence. So that a lot of people, if you plan on ever paying your tax, you got to figure out when's it best to pay your tax. So, you may or may not want to exchange right now, depending on how that is. So you could exchange until you die, the step up in basis, kids inherit it, zero capital gains consequence. Now, if you have a client that says they inherited the property, don't eliminate them from 1031 exchange. Because let's say they inherited it 10 years ago, and now they have a gain from when they inherited it to now. They still may need to exchange. So if you get the inheritance situation, they died, they inherited 2 months ago through whoever passed away, they can probably sell it at zero capital gains consequence. But 10 years ago, they probably have a gain from 10 years ago to now. Equal or greater equity. So again, all the equity coming out of the sale should roll into the purchase or replacement property to defer all your taxes. There's a misconception out there. The bottom note you see there, fresh cash can be added to offset debt. So if I sell a property for $1 million, I have $600,000 equity, and I pay off a $400,000 loan. When I go to buy my new property for, let's say, $1 million to meet my equal or greater value, I'm going to bring in the $600,000. The other $400,000, I could either get another loan or bring in cash to offset that debt. So if they had the cash and wanted to do that, that's okay. It doesn't create a tax consequence. A lot of people think they have to get an equal amount of debt as they have on the relinquished property, and that's not true. Okay, next slide, Jerry.
Hey, Ken, do you want to address a couple of these questions right now?
Yeah, we can jump into some of the questions.
Okay.
Let me jump into the chat and see. Oh, hold on.
And while you're taking a look, I have a question. Does it matter how people inherit the property? Like, does it have to be through a trust, or does the method of how they inherit the property matter?
Yeah, that's very important, especially for agents. I know a lot of us, we're not allowed to give advice on how to take title to the property. The trust is the best way to own it. If you own it as, if a husband and wife pass away and they owned it as husband and wife as joint tenants, they may not get the step up in basis. So you got to be careful, especially if you're advising your clients on how to hold title. And this is more your expertise than mine. You got to be careful on how you're doing that, because if someone does pass away, are they going to get that step up? So you got to be careful. Definitely a trust is the main way to hold it, to receive that step up in basis. I don't know if you want to expand on that on the title side of things.
Well, in my experience, yes, holding title in a trust, and if even if it's not in an exchange situation, if you hold title in a trust, you pass away and your kids inherit it, they get a step up, or whoever inherits it, whoever the beneficiary might be, it may be your kids or whoever you designate as your beneficiary. So we, yes, we can't advise how people hold title, but usually the trust is the best way in our experience also.
Yeah, okay. So a few questions. Basically, we're asking if I can provide you with a PowerPoint. Yes, I can. I don't think we can record this through Zoom, but I have some recordings on previous classes I've done. If you guys want to re-listen to something similar,
I'm actually recording this now.
Oh, good. Oh, I didn't know we could do that through Zoom. Perfect. So we can maybe even be able to send you the recording of this, and the PowerPoint slides that Jerry's pulling up for us right now. You'll have access to that. And then you always have access, obviously, to Jerry, Eric, and myself to help you through these questions too. Would you be interested in holding the same training with NAREP, San Gabriel Valley? I'd love to. That's pretty much, what I'd love to do is if you want to get me in and do another class for another group, definitely let me know. We'll coordinate something, a time that works for all of us, for sure. If anyone has questions, please fill it. Okay, that's Jerry. Can seller carry still qualify for 1031 exchange? That's a good question. I'm assuming you're talking about seller carry financing, where the seller is giving a loan to the buyer with their equity. So remember, you want to buy property of equal or greater value and of equal or greater equity. So by doing seller carryback financing, that equity gets rolled up in the form of a note. So if it's in the form of a note, a piece of paper basically, how do you roll all that money into the acquisition of the replacement property? So it makes it difficult. They mix like oil and water. You really don't want to coordinate seller carry financing and 1031 exchange. But let's say they do. Let's say it's $100,000 seller financing. Instead of using the equity from the sale, if the seller has $100,000, they could bring it out of pocket prior to the close of escrow. They could use their own funds for the loan instead of the equity from the sale. So that way, all the equity from the sale could roll into the exchange, so they could fully defer their taxes. Or some will just exclude that amount from the exchange. And excluding that amount, you know, it's a tax deferral in itself. So let's say you structure a $100,000 loan, interest only, and it matures or balloons in 5 years. You really don't pay a tax on that $100,000 until 5 years down the road when you receive the principal balance payment. So if you guys have a situation like that, please call me so we could talk it through and discuss all the options. Because seller carryback financing does throw a wrinkle into the 1031 exchange. Hopefully that answers that question. What are the property needs repairs and rehabs? Okay, so when you trade into a value of the property, and I am gonna, on a future slide, I'm gonna get into an improvement exchange. But for now, let's just say you're trading into the value of the property the day you acquire ownership to the property. But let's say you sell for $1 million, you buy for $950,000, and you're going to do post-closing improvements of $50,000. You know, you traded in, you actually traded down in value. I'm going to say you're going to have a tax consequence, but you could write off those improvements too. So a lot of times those improvements and even commissions, escrow fees, title fees could offset some of the trade down in value. So don't think your client has to, or you don't have to buy of equal or greater value. Remember, you just may be creating a tax consequence on the difference. So you're trading in the value of the property the day you acquire ownership, and I'll expand on that on a later slide on how you could actually include improvements. It's actually one of our more complicated types of transactions. So fresh cash added into the exchange won't be taxable. So the seller decide not to do. Well, they won't add fresh cash into the exchange unless they actually buy replacement property. So we wouldn't have them add cash to the exchange. We would only hold the equity. They would only deposit the fresh cash upon the closing of the acquisition property to offset the debt. So if they were to fail their exchange and not buy replacement property, we'd send them their funds back. They would never fund in the fresh cash. So that would only be in the event of closing. Talking to Eric about setting up the additional class, that's fine. Can we have your contact information? Yes. So shoot me an email. My contact information was up front. I think Jerry said he'll send us more information on this. And actually, my last slide will have more information on my contact information too. Can we have your contact? Title says, yeah. I think that's it for questions now. Hi, Dorothy. Yeah, I think that's it for questions now. So let's jump back to the slides. And I'll expand. Oops, hold on. Okay, so here's a couple scenarios. This is a cash boot situation. So it sold for $300,000, paid off a loan of $100,000. So $200,000 equity cash comes out of the sale. Buys for $300,000. That's good. You bought of equal or greater value, but they got too great of a loan. So the loan amount is $150,000. So now only $150,000 is due to close the escrow, which would leave $50,000 boot and taxable because we couldn't fund in all the money. So that's something to think about. Be careful with the loan amounts. You want the lender to know how much cash is coming in so that they don't create a boot unless the client wants boot. We could create a situation if the client wants to take cash and just pay a tax on it, that's fine. We could do that. That's not a problem. Okay, so let's jump to the next slide. Same taxpayer requirement. I think we jumped to, Jerry. I think there was one more. Okay, yeah, there we go. So this scenario this is a pure exchange. They've used all the money, they bought of equal or greater value, and they used all the equity. So they bought a greater value of $100, and they got a $200,000 loan, which was okay, even though that's a higher loan amount than the $100,000 loan that they paid off. because it's still using the full $200,000 equity. So this is a good exchange. They're able to defer all their taxes. They bought of equal or greater value. They bought of equal or greater equity. So as to one of the questions that I just answered, you know, you have that loan amount. Let's say your client didn't want to get another $200,000 loan or a $200,000 loan. If they had $100,000 cash, they could bring in cash into that closing, get a $100,000 loan, and then we fund in the other $200,000 to complete the purchase price. So there's variations of ways they can do it. So in order to defer the taxes, again, just think equal or greater in value and equal or greater in equity. Now we can jump off to the next one. Same taxpayer requirement, we jump. So I mentioned before, if I'm Ken Harris selling, I have to be Ken Harris buying. So there are a couple exceptions to this, trust and single member LLC. So don't think of it as the same vesting requirement. There's a misconception out there of if property was held as husband and wife as joint tenants, that must be purchased as husband and wife as joint tenants. That's not true. So as long as the taxpayer remains the same from the previous year's taxes to the future taxes, you'll meet the same taxpayer requirement. So it's possible for a single member LLC, ABC LLC, Ken Harris is the sole member and the taxpayer, because the single member LLC is just there for liability purposes, to sell under ABC LLC, and then Ken Harris buys, because the taxpayer remained the same. The vesting did change though. Same thing with a trust. Typically your trust is also a disregarded entity for tax purposes. So if that's the case, then the trustees of the trust can most likely go and buy the replacement property as individuals and meet that same taxpayer requirement. If a taxpayer dies during the exchange, the state or the trustee can still complete the exchange, but at that point you'd want to pull in their attorneys or CPAs to see if they even need to complete it, or if they want to complete it because of the step up in basis. So I guess that depends, that's a case-by-case basis. Hopefully that doesn't happen to you guys. Unfortunately, it has happened a few times. So in a scenario like that, obviously we have to talk it through, but it's possible for the estate or the trustee to proceed with the exchange. Jump to the next one. So this is a couple examples. Like I said, same taxpayer requirement. If it's a partnership selling, that partnership needs to be buying. You know, corporation selling, buying. The Wilson Revocable Trust bought as individuals, that's perfectly fine, because the Wilson Revocable Trust was disregarded for tax purposes, and Rick and Sue's Social Security numbers were the same taxpayer. So, and then the next one's Mary Jones as individual and then buys a single member LLC. Again, the single member LLC is disregarded for tax purposes, so that's fine. And then John Smith, 100% tenant in common interest. This one's interesting. So if John Smith sold for $1 million, John Smith can buy another piece of real estate with a partner. So, but John Smith would have to take that tenant in common interest as to his own name and Social Security number to meet his same taxpayer requirement. So if all of a sudden John Smith is going to partner up with me to buy a piece of replacement property, let's say John Smith in this example sold for $200,000. And now we're going to go buy a piece of property. We would need to buy a piece of property for $1 million if he's taking 20% interest in the purchase, so he can meet his equal or greater value. So he's only going to get the value of what he's acquiring in that property. So it is possible to partner up with somebody. It does complicate it a little bit. So again, that's something I would want to talk through with you and your clients to make sure if it's something that's possible for that deal. Next slide. Partnership is a separate taxpayer. Again, partnership sells, partnership has to buy. Individual partners, so drop and swaps. This is a common problem where ABC LLC has 5 partners. So it's not disregarded for tax purposes. And the 5 partners now want to sell and do their own thing. You know, maybe 2 of them want to do an exchange, but not together. The other 3 want to pay their taxes. Well, it creates a situation because the same taxpayer, ABC LLC, needs to be the partner that buys the replacement property to meet the same taxpayer requirement. Well, they say, well, no big deal. We'll dissolve the LLC, deed it to the individuals as to their own tenant common interest, and they each could go about their own business. Well, the problem with that is the holding period. You got to remember the previous year's taxes show ABC LLC as the partners. So it's a difficult situation. Franchise Tax Board audits these quite a bit. So it's definitely a red flag if you're going to do something like that. So we'd have to actually talk that through. So changing ownership right before you sell does not necessarily work. So jump to the next slide. Related party exchanges, jump to the next slide. So you got to be careful. You can't just buy from a related party. What's a related party? a lineal descendant. So anybody that is a parent, a grandparent, a kid, a sibling, that's basically who they're looking at as related parties. If you're swapping with a related party, just trading properties, each of you want to hold the property for 2 years in order for you to benefit from the 1031 exchange. Selling to a related party may be okay, as long as that related party owns that property for at least 2 years. And then buying from a related party is the most dangerous type of transaction, because if you buy, let's say I bought from my brother through a 1031 exchange, so I'm deferring a $100,000 tax consequence, and he's selling his primary residence with no tax consequence, that's where the IRS has a problem. So usually buying from a related party does not work. So be careful with that. Again, that's something I'd like to talk through if your client's thinking of doing something like that. Let's jump to the next slide. Reverse exchange. So everything I talked about to this point, our timing's looking good too. So everything I talked about to this point is a standard exchange. And the most type, you're going to sell first and buy second. And I'm going to talk about that and want your clients to do that type of transaction first, because you need to sell. The money needs to roll out of the property and then roll into the acquisition of the replacement property within those timeframes of the exchange. But there is an option of a reverse exchange. So let's say your client has to buy a replacement property before they're able to sell and close on the relinquished property. There is the option of the reverse exchange. So in the reverse exchange, what happens is we come in, we create an LLC, we buy the property on behalf of the client, and now we're going to park it and preserve it as a replacement property for a future exchange. So now when they sell the relinquished property, they sell, money rolls into the qualified intermediary, us, and then they buy the replacement property back from us that we previously purchased from them in the beginning. So, and they have 180 days to do this. So there's a lot of positives to this, but there's some drawback or basically some obstacles that you have to overcome to do this. So let's jump to the next slide. So what are the advantages and drawbacks of a reverse exchange? Closing without a contingency. So a lot of times in an exchange, you want to try to get the replacement property contingent upon the sale, which I know is difficult. The difficulty on a reverse exchange, or I should say on a contingent deal, is that seller of the replacement property willing to wait for the sale of the relinquished property. So in a reverse exchange, you don't have to wait for the sale. We come in and we buy that property on your behalf. And then the most stressful time in the exchange is that 45 fine. Well, in a reverse exchange, once you close on the sale, the identification is easy. It's the property we already parked in the reverse exchange. So it kind of eliminates the 45-day stressful identification period of your replacement property and wondering if you could get what you identified within 45 days. So those are positives to the reverse exchange. The drawbacks, where's the money coming from to buy the property? So we don't provide the funds to buy the property. So does the client have cash funds to buy the property? If they don't have cash funds, are they obtaining a loan to buy the property? Is that lender willing to work with us as a non-recourse loan to a new LLC that's taking title to the property? A lot of times it's a big obstacle and could squash a reverse exchange transaction. Additional costs. I think I saw in the chat room a question just come up. I always like to say the reverse exchange is probably going to run you at least an extra $10,000 in fees and costs. It sounds like a lot. You got to remember, if your client is saving a few $100,000 in taxes, spending $10,000 in fees and costs might not be that big of a deal. So it's definitely more expensive. Some of the clients will pull back and not do this because of the additional costs, but it's a great tool if you can get by the financing issues and the additional fees and costs. So you got to figure at least $10,000. And I'm saying that because there's additional expenses. There's LLC tax costs. There's an additional closing. You got to remember, we're coming in, we're buying the property, and then eventually to satisfy the exchange, we have to transfer the property back to the client. So you have, additional document transfer tax, recording charges, transactional costs there. So there's an additional transaction. And then anything that is non-residential, so anything that's greater than 4 units, we require a phase 1 environmental report. So the phase 1 environmental report needs to be sent to us. It needs to be clean for us to take ownership to it. That may or may not be an additional cost, because if you're getting a loan anyways, especially commercial lenders are going to require it anyways. So it may or may not cost. So go to the next slide. Build to suit. So build to suit, so that's the reverse exchange basically. We can buy the property and park it and preserve it as a replacement property for the future sale of the relinquished property. So the improvement part, the questions that I answered, this is what I was talking about on the improvements. When you buy the property, you're buying the property at the value of the property the day you acquire ownership. So let's say your client sells for $1 million, they're buying for $700,000. But they know they need to put $300,000 of improvements into the property, and they could do that fairly quickly. We could do an improvement exchange. So in an improvement exchange, it works a lot like the reverse exchange. What we're going to do is we're going to come in, we're going to create an LLC, we're going to buy that property on their behalf. So when we buy that property on their behalf, well, the reverse exchange, going back to the reverse exchange, we take ownership to that property because they can't buy it and then exchange into it. So we're avoiding them taking ownership because you can't exchange in the property you already own. The purpose of the improvement exchange is we can buy it and lease it back to them so they can put the improvements onto it. So when they actually acquire it to the property, they're acquired value plus the improved value of what they complete within 180 days. So there's your difficult part in the improvement exchange is how much improvements can you complete within 180 days? You know, if it's only $50,000, you know, it might make sense just to pay a tax on the $50,000 that you were trying to defer some taxes on because you're going to spend over $10,000 in fees and costs on something of this nature. But if you know you can complete $300,000 of improvements, which is going to save you $100,000 of tax, you know, you spend $10,000, $12,000 in an improvement exchange, it may make sense. So the improvement exchange point is we take ownership, we lease it back to them. They go on, get on the property, they improve it. Within 180 days of the first closing, we transfer the property back to them at the acquired value plus whatever improvements they completed within that 180 days from the first closing. Any exchange, always think of 180 days from the first closing, okay? And then the drawbacks for are similar to the reverse, the financing aspect of it. The one benefit you have in an improvement exchange is a lot of times the relinquished property is already closed. So we have money available to buy the property from there. So you don't necessarily have to come up with money out of pocket or sometimes don't even need a loan. So that every situation is different, but we could borrow the money from that exchange from your sale to buy the property and fund the improvements. So we bought the property for $700,000. Let's say we had $200,000 additional equity. We could fund the $200,000 additional equity. Now we have a $900,000 value. And after we run out of money, let's say the client puts another $100,000 of their own in improvements to the property within that 180 days. Now transfer the property back to them at the $700,000 plus the additional $200 that we funded for improvements that have been completed, plus the $100 that they completed in improvements, they get the property back at $1 million. So it's probably the most complicated transaction in an improvement or it being an improvement exchange, but it's a great tool again if you need the value of the improvements on the transaction. But again, you have to be able to complete enough improvements. Sometimes it's not worth it. Again, you could write off the improvements in that year, which might offset some tax consequence if you just buy a lesser value. So again, that's something we would need to talk about and see if the client even benefits this before we proceed with a transaction like that. So let's jump off to the next one, which might be the end right here, I think. Yeah, questions, which I already jumped into a lot of the questions. Let me see, I keep going. Go ahead, Jerry.
There's a question, this is Eric, there's a question from Dave, a follow-up question. The person would just have to show receipts of the 300K improvements, correct, to justify the spending that amount?
Yeah, so in my example, we funded $700,000 from the exchange to buy the real estate. And then I said we had an additional $200,000 of equity from the sale. Okay. So, and then I said he funded in the additional $100,000. So yeah, we would get a financial report from him of what he funded on the improvements he completed, whether they be the invoices or just a breakdown. You know, we pretty much trust the client. Now, some people ask, well, what if I buy, you know, $200,000 worth of lumber and cement, and it's going to be done after the 180 days? That doesn't count. It has to be affixed to the property and done for it to count. So whatever improvements they complete, we look for like some type of financial, you know, breakdown of whatever they completed to add to the purchase price. Okay.
Hey, I had another question. Somebody was asking, once you pick identify the 3 properties, can you still change them? And if so, in what period and window of time?
Yeah, so you identify within 45 days. So some people will identify prior to the 45 days. So let's say they identify on day 30, and on day 40, things have changed. You could revoke your identification and change it at that point. After the 45 days, you're locked in. You must purchase what you identified basically by day 45. So if it's day 46, there's no more changing of the identification. So you got to be careful with that. So going back, I always say your best exchange is close today on the property you're selling, close tomorrow on the property you're purchasing. You don't want to identify. You could identify and not be an escrow or in contract to identify those properties. But you want to have something locked down by day 45 to feel confident. Because if you identify on day 45 and then go on day 50 and put offers and those properties are no longer available, then you're going to have a failed exchange. So that's the game you have to play. And then think about too, as you guys are accepting offers on the relinquished property, think of your closing date. A lot of people get excited if you get an all cash offer from an investor and they want to close in weeks. And that's great. But if your client, your seller wants to do a 1031 exchange, do you really want to close in 2 weeks? Remember, close of escrow is the trigger of your time deadlines. So maybe you want to push that out 30 days, 60 days to buy yourself more time to find property for your client. So, and then of course, right now is the COVID-19 situation where there's 45 days, but that's rare. Again, don't go into any exchange ever thinking you're going to get an extension. They've never issued an extension on an individual basis. You got to have some type of COVID-19 situation for them to issue a general extension for 1031 exchange.
Thank you, Ken. We have a couple more questions in the chat. Dave followed up with this question. He said, what are your thoughts on tenants in common TIC versus doing a traditional exchange?
Well, okay, I think that question is more geared towards like a TIC transaction where you got a broker owner, I believe, or maybe a Delaware statutory trust. I mentioned REITs earlier, where you cannot exchange into a real estate investment trust, but you could get a Delaware statutory trust where you're taking tenant in common, a 2% interest in a portfolio of properties, which the IRS has allowed as real estate, which is fine. If you're asking my opinion on, it's allowable for 1031 exchange and consider real estate on a TIC transaction where you're actually taking ownership to the real estate, or a Delaware statutory trust where you're still taking ownership to the real estate of portfolio of properties. Is it good? It's good for some clients. It's not good for some clients. You got to be careful. You got to do your homework. Your exit strategies aren't as good. You're kind of at their mercy and when the broker dealer wants to sell the property. So if they want to sell it in 5 years, remember you pushed gain to the next property. So now you're in the same boat 5 years from now when they want to sell that property. So a TIC transaction, basic, I sell, I do an exchange. Now, Jerry, you and I are teaming up to buy a property. That's fine. You just got to be careful of your values. But as far as buying into a DST or a TIC program, I don't try to lean a client one way or another on that. I let them do their homework and see what's best for them. Some people love it because you eliminate the management of property. So in eliminating the management of property, they collect a little income. They've pushed off their gain. People do like it. So there's pros and cons to it.
Awesome.
Hopefully that answered it.
And Ken, Rose is asking, can you further explain the 200% rule again and in the time frame?
Yeah, so 200% rule is you have 45 days to identify it. So you have to identify under the 3 property rule or 200% rule. The 200% rule says I could identify 4 or more properties, but I have to apply a fair market value to every identified property. The total combined value of all identified properties, whether you're going to purchase them or not, cannot exceed 2 times the value of the property you sold. I'll use an example of a client I've done in the past. They sold for $2.5 million a piece of commercial property, and they wanted to get out and buy residential. So they sold for $2.5 million. So they were able to buy a bunch of single-family residences. So they were able to identify, they were buying like $200,000, $300,000 single-family residences. So you could actually, I'll use $500,000 value just for the sake of the conversation. You could actually identify 10 $500,000 values because 2.5 million sales price, 2 times that value is $5 million. So you could being 200% of the property you sold. So you have to apply a fair market value. It cannot exceed 2 times the value of the property you sold. Hopefully that helps. If you need me to expand on that, we definitely could get on the phone or go back and forth on emails.
And Winnie asked, can they buy 5-bedroom house, use a 4th bedroom, use 4 bedrooms as primary, and then rent out the other one as an investment? Yeah,
you could do that. If you're going to do that in an exchange, though, like you sold let's say you sold $1 million piece of property, and now you're going to buy a 5-bedroom house. Let's say the 5-bedroom house is a $1 million property. We can only assign ourselves into and apply funds towards the investment portion of the property, right? So let's say the primary residence, just for the sake of the conversation, primary was going to be 50%, and then the other 50% was going to be investment. Now you're only trading into $500,000 because half is going to be used as primary, half is going to be used as investment. So if you sold for $1 million, you're buying for $1 million, but you're really only trading into $500,000 because you're only trading into a $500,000 investment portion of the property. You got to be careful with something like that, but it is possible, but you got to be careful with your values.
Okay. Does anybody have any other questions? I don't see any other questions. I hope it doesn't. Oh, how much does exchange company charge? So
any property sold under $1 million is a flat $1,000 fee. This is a standard exchange, sell first, buy second. Anything north of $1 million, in between $1 million and $5 million is $1,500. And anything north of $5 million is $2,000. That's collected at the close of escrow of the property being sold. And no additional fee when they close on their first purchase. So if they sell one and buy one, it's, let's say they sell for $800,000, they buy one, it's a flat $1,000 fee. And that's the same for every price. Okay.
Somebody asked, Sandy asked, for each 1031 exchange, does the depreciation carry over?
Yeah, it does. So you got to be careful. Yeah. So it's actually your basis that carries over. Right? So if you have a client that's selling and wants to exchange, that's a great question. So if you're selling for $1 million, but you've depreciated that property down to nothing, you can't depreciate it past 0, right? And then you go buy for $1 million, the equal value, you cannot depreciate that asset because remember the basis of the property transferred over to the next property. So in a scenario like that, you'd have to buy a greater value. So I sold for $1 million. I need to buy for $1.5 million to have another $500,000 to depreciate. So yeah, in a sense, the depreciation does transfer over, but you really are thinking of it as the basis is transferring over. So if you depreciated it down to your basis, you can't depreciate it anymore. So you got to be careful in a scenario like that. You might have to buy a greater value to create another depreciable asset.
Awesome. Thanks for the question, Dave. Does it matter? Let me see. They're saying, is the 1031 exchange an interest-bearing account? If so, can seller of exchange properties earn interest?
Yeah, they earn 100% of the interest. It's basically pennies today. But they earn 100% of the interest. We could apply that towards the acquisition of the replacement property, or just send them a check, separate at the end of the close. But yeah, it is an interest-bearing account. It doesn't earn a lot of interest because, we have to keep the money liquid and be ready to close on investment property or apply a deposit at any point in time.
Okay. And then I think we got one more. Nicole asked, does it matter how many properties they buy?
You just want to buy of equal or greater value. So I guess yes. Remember the identification rules. You can't identify the entire state of California. So if you can't just identify 1,000 properties and then choose from there or buy 1,000, unless you fall within that 200% rule. So you could buy 10 properties, but again, you wouldn't be able to identify more than 2 times the value of the property you sold. So just think of what you want to do is buy of equal or greater value. So that takes 1 property, or 2 properties, or 3 properties, 5 properties, that's fine. But at some point you've already deferred all your taxes. You don't need to keep buying property through the exchange. Okay.
One more thing.
I saw it's from Dave. Sell a business. Businesses are not exchangeable. You got to remember it's the real estate that has So a business, if I own McDonald's and I own the real estate and I'm selling both, you have to separate a value for the investment property, the real estate portion, and a value for the business. We can only assign ourselves into and exchange the real estate portion.
Hey, Ken, Nicole had a follow-up question for that $1,000 exchange fee. Can they exchange for more than one property?
Yeah, so that includes the one purchase. There is a $200 fee for each additional purchase starting at the second acquisition. So if you sold one and bought three, it'd basically be $1,400 total for the exchange.
Awesome. Well, thank you, Ken. Thank you so much. That was really, really, really informative. Does anybody have any questions before we wrap it up? If you guys would like, Ken, is it okay to share this video that we recorded?
Yeah, please share the video. Let us know if you guys want the slides. Jerry has them, I have them. Feel free to give me a call anytime. And if you think of any questions here in the future or although I have another appointment after this, but just give me a call, we'll talk it through.
Awesome. Well, guys, what I'm going to do, Eric and I, what we'll do is we'll upload this video onto our YouTube channel. And then you can either contact us for the video and the slide. I'm sure you have my information, you have Eric's information, and on the screen you also have Ken's information. He can share the slide with you as well. We're happy to share this info with you. Just give us about a day. We'll upload everything and shoot us an email. You probably have, you guys all have our info. Shoot us an email and we'll make sure we reply to you at least either by today or by the end of tomorrow. All right. I think that's it, guys. Well, thank you so much. Eric, do you have any final comments?
No, I dropped Ken's info in the chat, but if not, you can reach out to us like Jerry mentioned and we'll get it to you. One last thing that I do want to mention is farming. So Jerry and I are able to get farms for you guys of owners of multiple properties. So we can talk more about that, off this chat, but just so you know, so you can start thinking of ways to prospect for 1031 exchange.
Awesome. Well, thank you so much again, Ken. You've always been super, super helpful and full of great information. Really appreciate you doing this for us. Thank you so much, everybody. Thank you, Aria, for helping participate. And until next time, guys, have a great Friday. Have a great weekend. Take care.
Have a good weekend, everyone.